I would agree with that. The QE program is of similar size to what the Fed has done in the past, but I would a little bit of disagree on the effect of the QE program in Europe, of the ECB's program, because what you have to keep in mind, we had a shrinking balance sheet in the last 3-4 years. So even the QE, the ECB now announces, is simply bringing back the European Central Bank's balance sheet to levels we had within the crisis. And it's nothing like what the Fed and the Bank of England have done. They kept their balance sheet on a high level, while the ECB actually had some restrictive capacity in the last year. So it's really a catching up of something that the ECB took out of the market, and therefore my expectations on this program are not that high as it might look simply by the overall size of the program. And the other thing is, and that's what a lot of investors have learned when looking at the German government bond yield in May, that there's a liquidity issue in government bonds right now. Because given that the ECB has these QE program, is buying government bonds, the liquidity of this government bond market is not what it has been. These are estimations for the US Treasury market that have been done by Morgan Stanley, JP Morgan and Deutsche Bank, published in the Financial Times this summer. And here you see actually that liquidity really is decreasing in the government bond market. So we measure against government bonds, but we have to be aware of the fact that this market is less liquid than it has been, let's say, 5-8 years ago. And it's also therefore much more volatile today. So it's much riskier that your benchmark might shift quite heavily due to some small money is moved around, like we have seen in May with the German government bond rising nearly 1 percentage point within a couple of weeks. So that's a liquidity issue that possibly also justifies lower yield spreads again towards government bonds, because the liquidity premium property definitely might be a little lower required, given that the liquidity in the bond market is not that high as it has been historically. And the other thing, when you look at, let's say, Europe or the investor side overall, the search for property for product continues, as I labeled it here, because no matter which country you're looking at from institutional investors, everybody wants to, let's say, increase its allocation to real estate. And with all these investors, might it be Asian, US or Europeans, they focus on Europe, and if they look at Europe, then it's quite easy. What are they looking at? They're looking at the 3 big markets first. That's the UK, Germany and France. And therefore, no matter what type of movement you have into, that's the 3 markets that people enter first. And what you have to keep in mind, looking at Europe from a global perspective, you have 2 global cities, one is London, the other is Paris. So, and Germany has a different, let's say, structure, therefore it's much harder for the investors to understand. So the natural entry point of most of these investors is London and Paris. And that's also something that drives the underlying market movements, irrespectively of what you actually have on the economic fundamental side. The other thing all the stories are about today, when you look at real estate investment stories, is about demography. Everybody has understood that this is the main driver in the medium to long term. And looking at what's happening, you have an aging process going on, less so in France due to a much younger, much more higher birth rate in the French economy. So the French economy on that side is well positioned. And looking at the population, city sizes, there's a lot of cities outside Paris that are of decent size compared to the overall French population. So there's also opportunities outside simply from the pure market size argument. Another thing, actually, when we try to evaluate the current market situation, what we have to keep in mind, we all talk about comparison to 10-year averages, that we reach an all-time low in prime yields. First of all, these are all correct assumptions, because if you compile the statistics right, that's correct. But you have to keep one thing in mind. What I want to show you with this slide is a little bit of, we are actually not living in a mean reverting world, so we have to keep in mind that not everything goes back to a 10-year average, 15-year average, or whatever. What I plotted here is the overnight rate for the last 35 years. And that does not look very mean reverting, at least from my point of view. So the question is, if we talk about all-time lows for property yields, there's a good argument that they can go much lower going forward, simply because we are not returning to any average that is somewhere given out of the historical data. And therefore, going forward, just to give a brief idea what our views on the market is, we think that prime yields in France will compress further, and we see some prime rental growth definitely going on. And that holds for the office rental market as well as for the retail market. That's just to, given that we have a scarcity of supply for prime stock, not only from the investment point of view, but also from a tenant's point of view, especially in the retail segment. And now, taking possibly a little wider view on Paris and France, what's quite interesting if we start with the demographic side is demand is not only in the Ile-de-France. Actually, you have population growth across France. And what is quite interesting, if you look at city size and population growth, the larger cities do not attract relatively more population. So city growth, expected growth in cities, we would say is occurring across France. Yes, Paris is attracting in absolute numbers the most people, but relatively, Paris is not growing much faster than, let's say, Lyon, Bordeaux, Toulouse. So there is demand outside France. Although I have to say, looking at from these purely demand side, that's more a picture for residential and retail and less so for the office, because office is something that clusters more together and therefore demands a little more of a stronger view on a stronger focus on city level. And the other thing is, if you're an investor in residential, and as we have been one in Paris, we took a little bit of a closer look, and that's quite interesting. Normally, everybody has the view that demography, population growth is influencing rental growth. If you look at the resi market across Europe, this relationship seems not to hold. And if you look at France, which are the gray dots over here, it's not holding at all. And that's simply because of regulation. And there it comes in, possibly that we're in a lawyer's office helps. You have to understand the regulatory environment you're operating in. In France, you have a very strong rent regulation on the rental market that actually regulates how far you can increase rents in all the major metropolitan areas. And therefore, population growth is simply not a driving factor. And if you invest in these type of market, you have to understand what the regulation in the market is about to really get the best out of your investment. Oops, yeah. And the other thing is, and possibly, yes, France might be a higher regulated market, but at least the regulation has been more or less quite stable. It's not very volatile. And that's also something for an investor. Regulation in itself is not the issue. It's about the stability of the regulation. As long as it's quite stable, you can adapt to, you can structure your operations around these regulatory issues, and that's what you have to keep in mind. And therefore, just to give you a short picture on where we see rents and prices moving, we see rent and price growth now occurring in more than in the Ile-de-France area, if you look at the residential market. So there are some spots around the second-tier cities in France, if you look at resi, that can be of interest. And the other thing is, also looking a little bit of the valuation side, France or French residential traditionally has quite a low return, low income yield. Nevertheless, it's still attractive compared to the bond yields. And in a European-wide comparison, there is an attraction for French residential. The only thing is, it's quite hard to get. And the other thing is, going forward, the return expectations are not that tremendously, but compared to historical levels, it's relatively attractive. It's the lowest return across the European countries we monitor, but that does not mean that's simply for holding investments. And I think that's the other thing is, when you're a residential investor, there's much more than the buy and hold strategy today. You have a split up sales, you can do portfolio optimization things. Therefore, there's a lot more in these middle yellow value add part of the residential investment side. And therefore, I think, given the demographics in France and given the structure in France, there's some potential also for residential to really generate some, in the European-wide perspective, comparatively attractive returns.